Okay, let's unpack this. We are diving straight into an investment vehicle that was um, essentially designed to concede that the vast majority of professionals are simply not good enough at their jobs.
Hmm.
And that, paradoxically, is the source of its massive, relentless, unstoppable success in the global marketplace.
That's a bold framing, but, well, the evidence overwhelmingly supports it. For decades, academic research has consistently shown that most highly paid active investors, the dedicated stock pickers operating within a specific market, they just can't outperform the relevant index.
Not over a long period.
Not over a long period, and especially not once you factor in the inevitable drag caused by their higher fees and trading costs.
Exactly. We're deep diving into the index fund. For many, this might be a familiar concept, but our mission today is to move far beyond the basic definition.
Right.
The goal is to truly understand the deep architecture of passive investing, the radical economic theory, the historical drama of its creation, the surprisingly sophisticated internal mechanics, and perhaps most critically,
The downsides.
the subtle disadvantages and systemic critiques that come with such an enormous financial force.
Think of this as a shortcut to being truly well-informed on an instrument that has, fundamentally reshaped how money is invested globally.
So at its core, what is it?
At its core, an index fund is wonderfully simple. It's a mutual fund or an exchange-traded fund, an ETF built with the singular purpose of replicating the performance of a specific preset basket of securities.
Like a stock index like the S&P 500, or maybe a bond index.
Precisely.
And the main advantage is distilled right there in the structure. Because it doesn't employ highly compensated managers trying to guess the market, it eliminates two major headaches for you, the investor.
Two big ones.
First, you eliminate the need to spend any time analyzing individual stocks or sectors. That work is already done by the index rules.
Mm-hmm.
Second, and more powerfully, index funds are just notoriously difficult for those highly paid active managers to consistently outperform once you factor in those costs, like high expense ratios and trading commissions.
And this isn't just some popular idea. It's one championed by the intellectual heavyweights of modern finance. What's fascinating here is the sheer credibility behind indexing,
Right. We are talking about proponents like Warren Buffett,
who consistently advises average investors to stick to index funds.
the late founder of Vanguard, John C. Bogle.
The Nobel laureate economist Paul Samuelson, the investment legend Benjamin Graham. When all these powerhouses of the last century converge on one philosophy,
You know it's worth a closer look.
it's worth studying in depth. It represents a kind of consensus that, for most people, the costs of complexity just completely outweigh the benefits of trying to pick winners.
Okay, let's unpack this then. The aha moments that launched an industry. Because this entire concept, which feels almost like common sense today, why pay someone a lot of money to be average, was once revolutionary
And even mocked.
and mocked mercilessly.
It was certainly a concept that took a long time to gestate. It started in these theoretical academic circles long before it ever became a product you could actually buy.
And the very first theoretical model for an index fund was suggested all the way back in 1960.
It was, and this came out of the University of Chicago from two academics, Edward Renshaw and Paul Feldstein.
What did they call it?
They suggested creating what they rather dryly called an unmanaged investment company.
Doesn't exactly roll off the tongue.
No, but while the idea was theoretically groundbreaking, it got very little actual support at the time. The prevailing wisdom was that professional management was the only way to get superior returns.
And the timeline to actually implement this was glacial. It wasn't until 1970 that the first fund actually filed registration with the SEC.
That was the Qualidex Fund, Inc., chartered in Florida back in '67. It filed its SEC registration in October 1970, which finally became effective in July of 1972.
And what was it trying to do?
Its objective was explicitly to approximate the performance of the Dow Jones Industrial Stock Average. So, technically, it was the first index fund to officially exist in the regulated U.S. sense.
But the real call to arms, the moment the academic findings were popularized and turned into a real philosophy for the general public, that came a year later, in 1973.
Right, with Burton Malkiel's foundational book, A Random Walk Down Wall Street.
That book was a game changer.
Malkiel's work was absolutely crucial because it translated dense academic research into clear, undeniable terms for the layman. The data showed that after fees, the vast majority of actively managed mutual funds were simply not beating the broad market indices.
He showed the proof.
He provided the empirical proof that the emperor of active management had no clothes.
He didn't just point out the inefficiency, though. He gave a concrete solution. He directly challenged the entire investment industry to simplify. I find his original call so powerful because of its directness.
What does he say exactly?
Bogle wrote, "What we need is a no-load, minimum management fee mutual fund that simply buys the hundreds of stocks making up the broad stock market averages and does no trading from security to security."
In an attempt to catch the winners. He was calling for the public to finally be able to buy the averages.
Exactly. And while Bogle was busy popularizing the idea for retail investors, the big institutions, the pension funds, they were already quietly making their move.
That's a really important dual track to see. Institutional adoption happen at the same time as this retail intellectual movement.
So who are the absolute first institutional pioneers to take the plunge?
That would be John McQuown and David G. Booth of Wells Fargo and Rex Sinquefield of the American National Bank in Chicago. In 1973, they established the first two S&P composite index funds.
But these were entirely private ventures, right?
Completely. And they were funded exclusively by pension money, which tells you a lot about where the trust was initially concentrated.
How much did they start with?
Well, Wells Fargo started its fund with $5 million from its own internal pension fund, and Illinois Bell matched that, putting $5 million of its pension funds into the American National Bank's version. This wasn't a product for you. It was a solution for massive long-term liabilities looking for reliable, cost-effective performance.
The retail market, however, had to wait for the arrival of one crucial figure, John C. Bogle.
The founder of the Vanguard Group in 1974.
And his inspiration wasn't just from the 70s academic trend, it dated back decades, right? All the way to his Princeton thesis in 1951.
That early thesis, the economic role of the investment company, it really formed the bedrock of his career. He then reinforced that original thinking by drawing on key research in the early 70s, including Paul Samuelson's influential 1974 paper,
which outright challenged active management,
and Charles Ellis's 1975 study, The Loser's Game. Both of them just confirmed his core belief that trying to beat the market was, for most people, a self-defeating endeavor.
It's remarkable that it took him over 2 decades to take that academic idea and make it an accessible public reality. And when he finally did,
the initial reaction was anything but welcoming.
They hated it.
Oh, the launch was met with massive skepticism and outright ridicule. Bogle launched the first index investment trust, which later became the famous Vanguard 500 Index Fund on December 31st, 1975.
The fund that is now the benchmark for the entire passive investment industry.
Yes, and at the time, competitors heavily derided it. They called it un-American because it didn't champion individual stock success. The most enduring insult, of course, was Bogle's folly.
I think the quote from Fidelity's chairman at the time, Edward Johnson, just sums up the psychological hurdle. He said he couldn't believe that the great massive investors are going to be satisfied with receiving just average returns.
That assumption that people need the thrill of beating the market was the established mindset.
It was just fundamentally wrong.
Dramatically wrong. While the fund started with a truly meager $11 million in assets, its trajectory was explosive. It was fueled by the slow but steady realization of its cost advantage.
Bogle even predicted it would surpass the Magellan Fund, right?
He did. In 1992, he famously predicted his index fund would surpass the colossal Magellan Fund, which was the king of active management at the time.
It did.
It fulfilled that prophecy in the year 2000. By November of '99, it had already crossed the astonishing $100 billion milestone. The Folly had become a financial giant.
If we connect this historical drama to its intellectual engine, the entire concept of indexing and its success, it ultimately relies on one core piece of economic theory.
The efficient market hypothesis, or EMH.
This is the foundation.
That's the absolute intellectual foundation. The EMH is the fundamental premise that justifies the existence and mass adoption of these funds. I mean, if the market wasn't efficient, you would pay an active manager to go exploit the inefficiencies.
So how do we define the EMH? Because there are different versions of it, aren't there?
There are. The Nobel laureate Jean Fama, who's often credited with formalizing the idea, states the most rigorous version, the strong version, to be the simple statement that security prices fully reflect all available information.
That's the academic ideal, where prices instantly know everything.
Exactly. This version basically says that information and trading costs are zero, meaning no one can ever profit because all information is already priced in.
But critics rightly argue that information is never truly free.
No, it costs time, energy, and a lot of money to acquire and act upon.
So what's the more practical version, the economically more sensible version that indexing actually rests on?
This version says that prices reflect information only to the point where the marginal benefits of acting on that information, so the potential profit you could make, do not exceed the marginal costs.
And those marginal costs are huge. We're talking salaries for legions of analysts, the cost of specialized trading desks, commissions.
Proprietary data things like satellite imagery or specialized economic indicators, it all adds up.
So the idea is that the competition is so fierce.
Precisely. The EMH practically implies that fund managers and stock analysts are competing so fiercely and so effectively that any new information is rapidly incorporated into stock prices.
And the conclusion is?
The conclusion is that it's extremely difficult for stock pickers to achieve an economic profit, that is, an excess return above and beyond those heavy operating costs.
So the core value proposition for you, the average investor, is straightforward. Since it's so hard for the experts to make a real profit after paying all their costs, most people benefit immensely from just avoiding that costly competition.
And simply buying a cheap index fund that mirrors the market average. It's a surrender, but, a profitable one.
It avoids the inefficiencies of trying to pick winners entirely.
It does. It relies on market-wide growth instead. And we should also briefly note that some legal scholars offer an alternative perspective for understanding the governance role of these funds.
Beyond just market efficiency.
Right, suggesting theories based on value maximization and agency costs, which reflects the massive stewardship responsibility these managers now hold.
Okay, here's where it gets really interesting for me. The internal plumbing. When we talk about an index fund, it sounds almost passive and simple. But how is that fund actually built in practice to make sure it tracks the index as closely as possible?
Because if it doesn't track perfectly,
the investor isn't getting the market average they paid for?
Right. The construction is straightforward in its objective track the index, but it's complex in its day-to-day execution. Index funds have to generally aim to hold each security in the underlying index in its respective weight.
And the most popular way to determine that weight is market capitalization.
That's right. Market cap weighted indexes are the gold standard. This means you hold a lot more of a company like Apple or Microsoft because their market caps are huge and a lot less of the smaller companies.
This method is often criticized for being top-heavy, but it is the most straightforward way to represent the total market value.
It is. But other methods exist, like equal weighting, where you hold the same dollar amount of every stock, or price weighting, which has largely declined in popularity. An equal-weighted fund, for instance, gives you a very different exposure, often favoring smaller companies over the giant market leaders.
But the fund isn't just a simple static list of stocks. It has complex internal rules designed to be smart about its trading.
Which is a surprisingly active part of passive investing.
Right.
Absolutely. The internal architecture is highly sophisticated. They use implementation rules specifically designed to minimize taxes, reduce what's called tracking error, and, crucially, reduce trading costs. Remember, they are executing trades for billions and billions of dollars.
So how do they handle those massive trades, especially when a new company is added to the S&P 500 without alerting the entire market and driving up the price against themselves?
That's the constant challenge. They employ what they call patient or flexible trading strategies.
So they don't just hit buy at 4 p.m.
No. That would be a disaster. It means they don't necessarily execute the trade immediately when the index changes. They spread the purchases out over time, sometimes using sophisticated algorithms to slowly accumulate shares.
They might also use large block trading.
Exactly, which is designed to minimize market impact and avoid what are known as adverse selection costs. That's the risk that the other side of your trade knows something you don't.
I find the variety of index targets fascinating. They really segment the global equity universe.
Yes, the universe is segmented by very clear rules. Equity index funds categorize stocks by characteristics like size, profitability, value, and critical geographic location, U.S., non-U.S. developed, emerging markets, or even the most volatile frontier market countries.
Which allows you, the investor, to select highly specific, targeted passive exposure.
Definitely. And we've also seen the enormous growth of factor-based indexes, which are basically indexing based on academic findings of what drives returns.
Things like small value, which has historically outperformed, or large growth, or quality factors like gross profitability.
Right. It's still passive, but it's targeted exposure to an empirically validated source of return.
The index providers themselves, the S&P, Dow Jones indices, FTSE, MSCI, they also have a unique and powerful role here. They aren't just scorekeepers.
No, They are, in effect, acting as market regulators.
Reluctant regulators, I've heard them called.
Reluctant regulators is a good term. Because these index providers are for-profit organizations, their decision to include or exclude a company has massive financial consequences. They determine suitability, often influencing billions of dollars of capital flow.
And they all have different practices, right?
They do. Some announce changes well beforehand, which allows arbitrageurs to act, while others do not make such announcements until after the change date to try and minimize that market disruption.
Now, let's dive into the 3 different ways funds actually execute the indexing process. We've got traditional, synthetic, and enhanced indexing.
Traditional indexing is the basic model. You own the representative collection of securities in the exact same ratios as the target index. It's the simplest, most transparent method.
And it relies on a technique called full replication.
Mostly, yes. Full replication is where the fund owns every single security in the index.
But what if the index is huge, like the 5,000 stock Wilshire? Do they still buy all 5,000?
That's where they start using what's called sampling. For extremely broad or illiquid indexes, full replication becomes impossible or just too costly.
So they buy a representative subset.
Exactly. The fund buys a representative subset of the stocks, weighting them to achieve the overall performance profile. This cuts costs, but it also introduces another layer of tracking error because you are, by definition, deviating from the index slightly.
Then we move to synthetic indexing, which sounds like some advanced financial engineering.
It's clever. Synthetic indexing uses a combination of equity index futures contracts and low-risk bond investments to replicate the performance. So instead of buying all 500 stocks, you might buy one S&P 500 futures contract and invest the remaining cash in bonds.
Why bother with that complexity? What's the killer advantage?
The primary advantage is tax efficiency, especially for international investors. Synthetic indexing can result in more favorable tax treatment, specifically by bypassing U.S. dividend withholding taxes that foreign investors might otherwise have to pay when owning U.S. stocks directly.
But there's a trade-off.
There's always a trade-off. The bond portion has to be carefully managed, and if they hold higher yielding instruments to get more return, that introduces corresponding higher credit or interest rate risk.
And finally, enhanced indexing, which, to me, seems like an active manager trying to sneak back into the passive party.
That's a great way to put it. Enhanced indexing is the attempt to juice the index. It's a catch-all term for active management improvements, things like customized indexes, specific trading strategies, or timing strategies.
And the goal is to offset tracking error.
The entire purpose is to offset the proportion of tracking error that naturally comes from internal expenses and transaction costs, often by making small, temporary bets. So they might be highly strategic about when they trade or position their bond holdings on a specific part of the yield curve.
But the moment you start doing that, you run the risk of eliminating the very cost advantage that indexing is built on.
It's a very delicate balance. Use slight active measures to reduce tracking error caused by costs, but don't add so much cost that the fund performs worse than the pure index.
Let's quantify that cost advantage.
Yeah.
Because it is the entire engine driving the success of this industry.
It is the engine. Due to passive management, the expense ratios, what you pay the fund manager, are dramatically lower. For a massive U.S. large company index fund, expense ratios can be as low as 0.03% to 0.10%.
And compare that to an active fund.
We'll contrast that with the average expense ratio for an actively managed large cap fund, which, even back in 2015, averaged 1.15%.
That seemingly small difference, just 1 percentage point, it really snowballs when compounded over decades.
It absolutely transforms your realized long-term return. Let's just run the numbers. Say a mutual fund produces a 10% return before expenses. For the index fund, after a low expense ratio of 0.10%, you get 9.9%. But for the actively managed large cap fund, paying 1.15%, you walk away with only 8.85%.
That's over a full percentage point difference in your pocket year after year.
Which can mean hundreds of thousands of dollars over a 30-year career.
And the difference is even more brutal when the market is performing poorly, because fees feel the same regardless of performance.
Consider a flat year when the mutual fund produces only a 1% gross return. The index fund investor still has a positive 0.9% return after expenses, but the active fund investor paying that 1.15% fee ends up with a 0.15% loss.
The fees ate the entire gross return and then some.
Exactly. It just illustrates that fees are the single largest predictor of underperformance.
That cost metric is key. We also mentioned the concept of tracking error, or jitter. To make this less academic, can we explain tracking error and basis points clearly?
Let's define basis points first. A basis point, often shortened to BPs, is 1/100th of 1% or 0.01%.
So 100 basis points equals 1%.
Right. When we discuss costs or tracking error, we use basis points because the numbers are so small.
Got it. So what is tracking error in that context?
Tracking error is the measurement of the difference between the actual index performance and the fund's performance over a specific period. Since the goal of the fund is perfect replication, any deviation, positive or negative, is considered an error or jitter.
So what causes that jitter if the fund is supposed to own everything?
Primarily three things. First, fees and trading costs, which we just discussed. Second is cash drag. The fund has to hold a small amount of cash for shareholder redemptions, and that cash isn't fully invested, so it drags performance down slightly.
And the third?
And third, sampling, which we mentioned. If the fund can't afford to buy every stock, that introduces a minor mismatch.
So what's an acceptable level of tracking error for a highly focused fund?
A well-run S&P 500 index fund, according to Vanguard, should aim for a tracking error of 5 basis points, or 0.05% or less. That's a sign of near-perfect efficiency.
But what's the reality?
Well, a Morningstar survey highlighted the reality across the broader industry. It found that the average tracking error across all index funds was significantly higher, at 38 basis points. That difference, that 38 basis points, represents efficiency, loss to fees, trading, and just poor management.
So what does this all mean for you, the investor? The clear advantages. Beyond the obvious lower cost, indexing offers significant quality of life and safety improvements for building a portfolio.
The first one is pure simplicity and transparency. The investment objectives are perfectly clear. Track the FTSE 100, track the Russell 2000, whatever it is. Once you know the target index, you know what securities are held, and portfolio management becomes low effort.
Your main job is just periodic rebalancing.
That's it. And that passivity naturally leads directly to the second major advantage, lower turnover.
Turnover being how often the manager buys and sells securities inside the fund.
Right. Active funds might have turnover rates over 100% annually, meaning they replace the entire portfolio every year. Since index funds only trade when the index itself changes, their turnovers are inherently much, much lower.
And why is that low turnover so crucial for your bottom line?
It leads to monumental long-term savings in three ways. First, lower explicit costs like brokerage commissions. Second, lower implicit costs like market impact, where big trades affect the price. And third, and most importantly for U.S. taxable accounts, low turnover minimizes capital gains tax charges.
Can you explain that tax benefit?
Sure. In many jurisdictions, when a fund sells a security for a gain, that's a taxable event, and the tax liability is passed on to you, the fund investor, that year.
So by minimizing trading.
Index funds defer those capital gains indefinitely. This means the money you would have paid in taxes stays invested and continues to compound for years or even decades. It's a huge hidden return driver.
And we can't forget the guardrails advantage. No style drift.
This is a critical protection for diversification. Style drift is when an active fund deviates from its stated strategy. Say, they were hired to be a mid-cap value fund, but they start buying large-cap growth stocks to chase a hot trend.
And if you're an investor building a globally diversified portfolio based on careful asset allocation, that style drift completely ruins your plan.
It does. It reduces the portfolio's intended diversity, increases your unexpected risk exposure, and can lead to overconcentration in one area. With an index fund, by definition, style drift is impossible.
The fund has to follow the public index rules.
It must adhere rigorously to them, maintaining accurate portfolio diversification, period.
Let's delve deeper into diversification itself.
Right.
You mentioned that index funds can still suffer from concentration risk even if they hold hundreds of stocks.
That's a key nuance. Diversification is defined by the number of different securities you hold, and more securities generally means less volatility. A Wilshire 5000 index tracking thousands of stocks is highly diversified.
But a niche biotech ETF tracking 20 volatile companies is not.
Exactly, but let's talk about the concentration risk in the giants, like the S&P 500.
Okay.
Indices like the S&P 500 or the FTSE 100 are market cap weighted, which means they are inherently top heavy. In the S&P 500, the top 10 companies can often make up over 25% of the entire fund's value.
So while you hold 500 stocks, your fate is tied heavily to the top 10.
Heavily. If those specific tech giants falter, the entire index gets pulled down disproportionately.
So what's the ultimate theoretical strategy for achieving true, globally maximized diversification, reducing reliance on any one country or company?
The ultimate strategy is often described as global indexing. This means investing in, well, literally every security in the world proportional to its market capitalization, often achieved by holding a mix of global ETFs.
Because global markets aren't perfectly correlated. When
No.
the US is down, maybe Europe is up, or emerging markets are stable.
That's the idea. There is generally less correlation between the returns of companies in widely different global markets than between companies in the same domestic market. By casting the net as wide as possible, you maximize the benefit of holding uncorrelated assets.
Now, let's look at the institutional trust. It wasn't just individual retail investors who jumped on this train. The world's biggest money managers now use index funds as a core tool.
Index funds are now an essential and foundational tool for sophisticated asset allocation. This is the crucial, high-level process of determining the right long-term mix of asset classes, stocks, bonds, real estate, to match a massive institution's risk capacity and liabilities.
And index funds capture these broad asset classes in the most cost-effective way.
And reliable manner. And the adoption by massive entities, particularly sovereign wealth funds and pension funds, is perhaps the strongest endorsement of passive management.
What are the numbers on that?
Research from the World Pensions Council shows that up to 15% of the overall assets held by large pension funds and national social security funds are now invested in various passive strategies. While active management is still the largest share, the trend is undeniable and growing rapidly.
What drove this massive shift in institutional thinking? These funds used to be the biggest customers of high-cost active managers.
Three key factors converged. First, the disappointment with actively managed funds consistently underperforming, especially after their huge fees. Second, after the 2008-2012 Great Recession, there was a systemic, worldwide push toward cost reduction across public services.
Fiduciary duty demanded it.
It did. Fiduciary duty demanded that pension managers seek reliable, lower-cost strategies. They needed certainty and low cost, not the promise of alpha that rarely materialized.
So public sector pensions and national reserve funds became early adopters.
Among the earliest and largest adopters of passive management, they moved from chasing the market to simply owning it.
But wait, there's a catch. For an investment vehicle that is supposed to be simple and low cost, the index fund isn't free from a very particular type of exploitation.
And it comes back to that tracking error we mentioned earlier. This is a critical hidden cost that often goes entirely unappreciated by the passive investor. Losses due to index arbitrage, often called index front-running.
Explain the game, because it sounds like index funds are essentially broadcasting their highly predictable trading intentions to the world's fastest algorithms.
They are, structurally. Index funds must periodically rebalance. This means adjusting their holdings to match the index's new weightings. These massive institutional block orders are public knowledge once the index announcement is made.
And this is where the high-frequency algorithms step in and skim value.
Algorithmic traders anticipate these massive block orders, knowing that the fund must buy or sell a huge quantity of shares at a specific time. Studies show these high-frequency firms account for about 80% of the trades in the top 20% most popular securities.
And they trade ahead of the funds.
They perform index arbitrage by trading ahead of the funds, anticipating the price movement the index fund's forced trade will cause.
So this is index front-running, and it's entirely legal. High-frequency traders profit directly at the expense of you, the passive investor.
That is the direct consequence. The process effectively transfers profits from the passive investor to the hyper-fast algorithmic trader. And the loss is not trivial either. It's estimated to be around 21 to 28 basis points annually for S&P 500 index funds.
Let's put that into perspective. What does 25 basis points mean on a $100,000 portfolio?
That means you're losing $250 every single year simply because the fund is forced to announce its intentions.
And for smaller, less liquid indexes, it's even worse.
For Russell 2000 funds, which track small caps where liquidity is lower and trades are harder to hide, the loss can reach 38 to 77 basis points per year. That 77 basis points is nearly as much as the annual fee for some active funds.
That loss shows up directly as a performance gap. It's the single largest contributor to the tracking error beyond the fund's own expense ratio.
Absolutely. The index rules and the resulting predictable trades are the open door allowing value to be siphoned away. John Montgomery of Bridgeway Capital Management famously called this the elephant in the room that, shockingly, people are not talking about.
And that arbitrage isn't confined to domestic markets either, right? You mentioned time zone arbitrage.
Correct. That related issue impacts international index investing. It happens when funds or their underlying stocks are traded on overseas markets that close before the U.S. market. Traders can exploit the price difference between the closing price on the overseas exchange and the expected closing price on the U.S. exchange based on intervening news.
And this is considered damaging to the markets.
It creates distortions and is considered potentially damaging to financial integration between the United States, Asia, and Europe.
This raises a really important question. What happens when too much money is concentrated in the same set of index rules?
This is the problem of common market impact or market distortion.
The theory says a company's value shouldn't change just because it's added to an index. It's the same company, same cash flows. But when indices become investment behemoths, reality differs from theory.
When immense amounts of capital are forced to track the same index, the rules of supply and demand are artificially altered. When a company is added to an index, say, a company is moved from the Russell 2000 to the S&P 500, the hundreds of billions of dollars of index capital that must buy it immediately create a massive demand shock.
Artificially spiking the price.
Yeah.
We saw this drama play out years ago when Tesla was added to the S&P 500. The stock soared in the run-up to the inclusion date.
Exactly. And conversely, when a company is deleted, it creates a massive supply shock, artificially lowering the price, which allows non-index players to acquire those shares cheaply. This is a form of structural price distortion that hurts the passive index investor.
So how do fund managers try to mitigate this?
One common way is by tracking a less popular index or even a proprietary index they create themselves. This can reduce that common market impact and hide their trading intentions a little bit.
Now let's look at the macro-level critique, which moves beyond trading mechanics to the very structure of the economy and corporate governance. This is where we talk about asset manager capitalism.
This is a profound and highly influential critique introduced by Benjamin Braun. He argues that the current financial structure, dominated by massive, diversified index providers like BlackRock, Vanguard, and State Street, is a governance regime distinct from the earlier era of shareholder primacy.
The core issue is the massive, unprecedented concentration of power. Because index funds demand a piece of every major company, a very small number of large asset managers end up holding huge, concentrated chunks of stock ownership across the entire global economy.
Exactly. And these massive asset managers are highly diversified across sectors. They own a slice of every bank, a piece of every airline, a segment of every tech firm. Therefore, they don't have a strong financial interest in the competitive performance of any one specific company within that sector.
If company A fails, company B in the same sector, which they also own, might benefit.
Right. And this leads directly to a massive agency problem in corporate governance. Since they are so diversified, these managers are primarily interested in the health of the market as a whole, not the success of individual firms.
So they tend to vote with management.
They are much more likely to vote with the company managers on issues of accountability, executive compensation, or strategy. They are universal owners who often act like passive bystanders.
And even more critically, Braun argues they have monopolistic incentives that hurt consumers.
That's the most chilling part of the critique. Since these funds invest in nearly all companies across an entire sector, say, they own 7% of Delta and 7% of United Rider, the asset managers actually benefit if companies behave cooperatively and maintain high monopolistic prices across the sector.
Aggressive competition that drives prices down hurts their diversified portfolio.
Precisely. The argument is that this system encourages consolidation and higher prices because the ultimate owners, the passive asset managers, don't care about competition. They just want the sector to be stable and profitable.
In the most extreme scenario, they could effectively buy the economy.
Meaning one or two entities exert control over the direction of corporate governance, potentially reducing overall dynamism and competition in the long run.
And this concentration of ownership has profound implications for wealth inequality, even if index funds are supposedly democratic and widely available.
It connects directly. While index funds are accessible, the reality of ownership is stark. The top 1% of the wealth distribution owns fully 50% of all corporate equity in mutual funds.
So critics suggest that things like wage stagnation can be viewed as an expected externality of a financial system dominated by this regime of asset manager capitalism.
A regime that prioritizes market stability and consolidated power over internal company competition.
Index funds versus index ETFs. It's not just in the name.
Yeah.
For the average investor looking for a low-cost passive option, these two structures look similar, but they behave fundamentally differently.
Especially when it comes to trading mechanisms and, most importantly, taxes.
How does the pricing schedule differ for you, the investor?
An index mutual fund prices its assets once a day. This happens after the market closes, usually at 4 p.m. Eastern Time. If you place a buy order at 10 a.m. or 3:59 p.m., you still get the 4 p.m. closing price.
But ETFs operate just like stocks.
Exactly. Index ETFs are priced continuously and trade throughout normal trading hours, usually 9:30 a.m. to 4 p.m. Eastern Time. So if major economic news breaks at 1 p.m. and you want to react, an ETF gives you real-time execution that a mutual fund cannot.
Now, for the most painful difference, which concerns U.S. capital gains tax. This phantom gain is a common headache for mutual fund investors that the ETF structure cleverly avoids.
This is a huge tax inefficiency. It stems from a specific requirement in U.S. law. Mutual funds are legally obligated to distribute realized capital gains to their shareholders annually.
And this leads to that classic scenario that feels inherently unfair.
It's the unlucky timing scenario. Imagine you buy into a mutual fund in December. Then, just a few weeks later, the fund is forced to sell some older, highly appreciated stock it's held for years.
Maybe to raise cash for massive redemptions that year.
And that sale triggers a huge capital gain. And you, who just bought in, are on the hook for that tax.
Even if my own investment is down.
Yes. Your overall investment value might even decline because the market is falling, showing an overall personal loss. However, you still receive a taxable capital gains distribution because the fund realized a gain on a security it sold. The IRS requires you to pay tax on that phantom gain.
And the ETF structure offers near-complete immunity from this specific problem. Why is the trading mechanism so different?
It comes down to the genius of the ETF creation redemption mechanism, which uses in-kind transfers. When large institutional traders want to redeem shares of an ETF, they don't get cash.
They get the stocks themselves.
Instead, they receive the underlying stocks themselves, an in-kind transfer of securities. Since the fund is handing over the appreciated stock to the institutional trader, and that transfer is not a taxable sale, the fund avoids realizing the capital gain.
So no taxable event is passed on to the remaining shareholders.
Exactly. It's a critical distinction for anyone investing in a non-tax-advantaged account.
That distinction is essential for U.S. investors. But tax complications get even worse for the global earner, particularly U.S. citizens investing internationally through non-U.S. funds.
Absolutely. The core problem globally is that mutual funds typically supply the correct tax reporting documents for only one country. If you are a U.S. citizen or taxpayer who invests in a fund domiciled in, say, Ireland or Canada, you face serious reporting hurdles.
And these can result in massive tax penalties.
They can. U.S. citizens should be extremely cautious about investing in any foreign-administered fund, especially if that fund qualifies as a PFIC, a passive foreign investment company, and doesn't provide the right paperwork.
And if it is classified as a PFIC and doesn't provide the right paperwork, what makes Section 1291 of the U.S. tax code so punitive?
It is punitive because it's designed to discourage citizens from hiding money overseas. Instead of taxing your gains at favorable long-term capital gains rates, the gains are treated as ordinary income, which is taxed at a much higher rate.
And it gets worse.
Worse, the IRS charges significant interest penalties on any deferred gain, retroactively applied back to the year the investment was made. This essentially destroys the concept of compounding and tax deferral, making the investment financially disastrous for a U.S. taxpayer if the paperwork is not perfect.
We've covered a remarkable amount of ground in this deep dive. We trace the journey from Bogle's Folly and the intellectual foundation provided by the efficient market hypothesis through the complex realities of index front-running and the superior tax advantages of the ETF structure.
And we finished with the big picture. The systemic critique of asset manager capitalism, where the sheer size and concentration of passive investment raise profound questions about market efficiency and corporate control.
It's a compelling narrative, moving from a scorned, unmanaged investment trust with $11 million to an economic force that now dictates the behavior of corporations globally.
If we connect this back to the bigger picture, particularly the discussion on asset manager capitalism and common market impact, there is a powerful and potentially paradoxical final thought for you to mull over.
Okay. We began with the EMH, the premise that the market is efficient because active managers are striving to find and act upon the truth, driving prices to reflect that truth.
They're constantly seeking new information, spending massive amounts of money on research, and acting on it, driving prices to reflect the true value of a company.
But if index funds become the overwhelmingly dominant way that money is invested, If the majority of corporate equity is held by passive managers who simply mirror the market and use their voting power passively, does the very act of passively replicating the market reduce the motivation or the ability for investors to enforce accountability on the companies within that market?
In other words, if everyone is just buying the average, who is left to police the companies to ensure they don't just become average? If the biggest shareholders don't care about competition or governance for any single company, does that governance vacuum reduce the market's overall efficiency? That is the central economic paradox. Does universal indexing, by removing the profit incentive for deep, expensive research and aggressive governance enforcement, eventually create a less competitive and less efficient financial system simply because no one is actively looking for the truth anymore?
It's the question that links the historical triumph of Bogle's Folly with the most serious governance critique facing finance today.
A truly profound thought.
A profound thought to consider the next time you look at your low-cost, set-it-and-forget-it portfolio. Thank you for joining us on the Deep Dive.
Until next time.